Hi, I'm Erin Prest. I'm a principal at Anders CPAs and Advisors, and I'm here to talk about the individual tax reform for 2018. Tax reform has been on everyone's mind for a while, especially since late last year when we started getting more details on specific changes. There were several items from the initial drafts from the House and the Senate that were changed, deleted, or completely new by the time the final version was signed. I'm going to cover some of the provisions from the 2017 Tax Cuts and Jobs Act that we think will affect the majority of our individual clients. Hopefully these ideas will give you something to think about and help you clarify the changes to help you plan for the impacts. Most of the tax law is set to sunset in 2025. One of the biggest changes was a decrease in the tax rates. For 2018, we still have 7 tax brackets. However, the top tax rate has been reduced from 39.6% to 37%. In addition, the taxable income ranges for the brackets have increased, so taxpayers do not reach the top bracket until $500,000 of taxable income for single filers and $600,000 for those married filing jointly. The new brackets help to reduce the so-called marriage penalty by making the lower 5 brackets exactly double the single brackets for married filing jointly, although there still is a significant difference for the top 2 brackets. The preferred tax rates on long-term capital gains and qualified dividends remained under the new tax law. Some taxpayers will continue to benefit from the 0% bracket, while most will pay 15% or 20% on this income. Under prior laws, the 20% bracket on qualified income kicked in at the highest ordinary tax bracket. With the change in the law, the 20% rate begins much lower. This could be a technical correction later, but for now, the 20% bracket begins with taxable income of $479,000 for married couples and $425,800 for single filers. The additional Medicare taxes from the Affordable Care Act still apply for earned and investment income once taxpayers reach $250,000 in adjusted gross income for married filing jointly or $200,000 for single filers. The standard deductions nearly doubled from their 2017 levels. Married filing joint taxpayers will have a $24,000 standard deduction, and single filers will have a $12,000 standard deduction. As a result of this change and some limits on itemized deductions, we'll see more taxpayers now taking the standard deduction. However, the personal exemptions that were allowed for taxpayers and each of their dependents have been repealed. Although the personal exemptions have been eliminated, the child tax credit increased to $2,000 to provide some relief for those losing the personal exemption. This credit is allowed for children under 17 and is refundable up to $1,400 per child, which means this portion can be refunded even after the federal income tax has been reduced to 0. In addition, a $500 non-refundable credit will be allowed for a non-child dependent, such as parents, children 17 and over, or other qualifying dependents. They also increased the phase-out thresholds by more than 3 times the prior limits for married filing joint couples, so many more families will be able to take advantage of this credit. Phase-outs now start at a modified adjusted gross income of $400,000 for married filing joint and $200,000 for single filers. Several changes were made with respect to the mortgage interest deduction. Under prior laws, mortgage interest was allowed on a primary and secondary residence up to $1 million in acquisition debt and an additional $100,000 in a home equity line of credit. Debt for new loans after December 15, 2017 is limited to $750,000 of principal. Home equity loan interest is no longer deductible, regardless of whether it's new debt or existing debt. There are some transitional rules if you had an agreement to purchase a home before December 15, 2017. Prior acquisition debt can be refinanced without jeopardizing deductibility. However, taxpayers cannot increase the amount of principal at the time of refinance. Refinancing a home equity loan into your mortgage doesn't automatically make it deductible. You need to be especially careful if your new mortgage exceeds $750,000. Pre-existing debt is grandfathered up to $1 million, but it's not allowed to increase the principal of your current mortgage. I think this will become more of an economic decision in the future since home equity isn't deductible. People will start to look to other loans like auto loans, student loans, and personal loans to get the best rate and best repayment terms for their personal situations. The state and local tax deduction was also significantly reduced. Under prior laws, individuals could deduct property tax and the higher of sales tax or state and local income taxes paid during the year. The new laws cap the total state and local tax deductions at $10,000. The $10,000 deduction is the same regardless of your filing status, so a married couple is not allowed to deduct $20,000. When initial drafts of the law were released, many saw an opportunity to prepay future years' taxes and take the deduction in 2017. However, the final version does not allow a deduction for 2018 taxes in 2017. Residents of high income and property tax states will easily max out this $10,000 threshold. Some states are already calling this unconstitutional and are actively trying to change this portion of the law. We'll keep watching to see what happens. The $10,000 does not apply to property and sales tax incurred in carrying on a trade or business, so individuals will not be limited on those deductions. This limit, along with the increases to the AMT thresholds from the Act, will also help keep many taxpayers out of AMT, since state and local income taxes were typically one of the biggest add-backs for the AMT calculations. All of the miscellaneous itemized deductions subject to 2% have been repealed. There are many different expenses that were previously deductible in this category, so I'll touch on a few of the more common deductions. Unreimbursed employee expenses, including the home office deduction for employees, are no longer deductible. Tax preparation fees are also no longer deductible unless they relate to trade or business income. Investment management fees paid will not be deductible. However, investment interest can still be deducted as an itemized deduction. The limit for cash contributions to public charities increased from 50% of AGI to 60%, allowing larger charitable deductions to be taken each year. There is one big change for die-hard college sports fans. Previously, donors were allowed to deduct 80% of the payments made to universities for the right to purchase athletic tickets. That deduction is now disallowed. More individuals will be taking the standard deduction, so itemized deductions will not matter as much. But we know St. Louis is a generous community and will continue to give even if they're not getting a charitable deduction. We believe there will be a bigger emphasis on timing, so people may double up their contributions in 1 year or use a donor advised fund to itemize deductions 1 year and take the standard deduction in alternating years. Qualified charitable distributions will also become more important in 2018. Individuals who are 70 and a half and older will be able to distribute to charity directly from their IRA and not have to include the IRA distributions in their income. Here's a simplified example of the changes between 2017 and 2018. Medical expenses are deductible for 2017 and 2018 for the portion of expenses that exceed 7.5% of AGI. After 2018, the 7.5% increases to 10%. The next 3 deductions are state and local income and property taxes. Those will be limited in 2018 to $10,000 for the entire category. Mortgage interest and charity would continue to be deductible as long as the limits aren't exceeded. And the miscellaneous itemized deductions are repealed for 2018. We go from $40,000 of allowable itemized deductions in 2017 to $23,000 of itemized deductions in 2018 for the same expenses. With the significant increase in the standard deduction, in this example, taxpayers would have been itemizing in 2017 and then would be better off taking the standard deduction in 2018. I think this will be a fairly common scenario for many taxpayers, and many may look to timing their deductions, especially charity, if they're on the verge of itemizing versus taking the standard deduction each year. This question really depends on your personal situation and the specific deductions you are taking. While there is a very limited amount of itemized deductions you can take this year, the decrease in tax rates, an increase in tax brackets, and the increase in the AMT thresholds will all help to reduce the tax that individuals are paying. The child tax credit is also expanded significantly, and business owners especially will be able to take advantage of a new deduction to offset some of their business income. Traditional IRAs can still be converted to Roth IRAs. In doing so, you pay the tax on the IRA now in exchange for tax-free withdrawals in retirement. Previously, taxpayers had the option to undo their conversion by the extended due date of their return, called recharacterization. This redo feature gave taxpayers time to see how their investments performed during that time and get a good picture of where their total income would be for the year. With tax reform, recharacterization is no longer an option for 2018 and future conversions. Taxpayers will have to be a little more confident that the Roth conversion makes sense for them. If the stock market declines from the time of the Roth conversion, taxpayers can now end up paying taxes on value that is no longer there. A significant change for education is the expansion of the 529 plan. In the past, only college tuition and related expenses were qualified for tax-free deductions from a 529 plan. Now, taxpayers will be able to use their 529 plan for kindergarten through 12th grade tuition expenses as well. Distributions for elementary and secondary school are limited to $10,000 per beneficiary per year. Many states, including Missouri, allow a deduction for contributions to a 529 plan. Earnings grow tax-free and qualified distributions are tax-free, so this will allow another way to help cut education costs. The estate tax was not repealed. However, the lifetime exemption doubled, which will greatly reduce the number of individuals subject to estate tax. The exemption is now over $11 million for each individual, so now only very large estates will be subject to estate tax. Since such a small percentage of taxpayers will be subject to estate tax, income tax planning becomes much more important than looking for ways to save estate tax. It's important to review your estate planning documents, especially if it's been a while, to make sure everything is still appropriate for your estate. This increased exemption is currently set to sunset at the end of 2025. This was a summary of some of the highlights of the 2017 Tax Cuts and Jobs Act. Although the tax rates dropped and the brackets expanded, the limits on itemized deductions may not bring the overall tax down as much as expected for some taxpayers. There are many more changes in the Act, and we expect to have some updates as the regulations are written around a new tax law. Stay tuned to our blog on our website at anderscpa.com and sign up for our newsletter to get the latest information. And as always, reach out to us with specific questions and we'll be happy to help you make sense of the new laws for your personal situation.